Core CPI came in hot this week. Is the yen carry trade still unwinding and the banking sector is under pressure? This and the team's thoughts on the first Harris-Trump debate on this episode of Investment Insights from Opal Capital. Thanks for tuning into this episode. My name is Jay Coulter. Joining me, as always, Adam Mueller and Austin Graff. Let's jump right in. Core inflation came out today. And as you can see from this chart, it's a little bit hotter than expectations. Adam, what are your thoughts on the implications for this for portfolio construction?
Yeah, I don't think that today's reading sort of changes anything. I think we're on a glide path towards a base case of a 25 basis point Fed cut in September. And something would have to happen extreme in either direction, I think, for that to change. I think that's fairly baked in. So look, I don't think this is cause for any portfolio changes. It's just another data point that speaks to where I think the base case of where the market thinks we're at, which is a 25 basis point cut, and an economy that's doing okay, but clearly slowing down and starting to show a few cracks on the edges, which is I wouldn't say cause for concern, but cause to pay particular attention to each incremental data point.
Austin, what are your thoughts?
I think it's interesting because the fixed income market did appear to get a little ahead of itself on the interest rate cuts. It's also quite fascinating to watch the talking heads talk about how the Fed's behind the curve and they should be doing 50 basis points or more. And then you have other talking heads saying that, maybe they'll do 25 basis points. It sure does seem like 50 basis points would be overdoing it given the CPI print today. And the market seems to be adjusting to that a little bit. And it'll be interesting to see how this goes. As we've kind of said over the last few months, instead of focusing on one data point, let's try to focus on the data in general, because data points tend to get revised over time. And so focusing on one point may lead you astray when it comes to making investment decisions.
Austin, how much weight do you put on core CPI versus the big CPI print?
I think another question might be how much weight do we put on CPI, and it's actually very little. It's good to understand how the market's reacting to some of the data and data points that come out, but in reality, this is all backwards-looking data, right? And so we're trying to invest on a forward-looking basis. So we'd like to understand where the economy is. In reality, the revisions are going to have a greater impact than any data point that's coming out, and we try to keep that in mind as we look forward for what we think are the likely outcomes in the future.
And I think that goes for every key data point that people are focused on right now, right? Whether it be CPI or PPI or the unemployment rate or the monthly jobs number or the weekly jobless claims. Any huge market reaction to one of those single data points suggests that the market is trying to figure out what's going on, doesn't know, their volatility is up, and we're at some sort of kind of inflection or potential turning point. But each individual data point taken on its own, you can't put too much emphasis on.
Yeah, going forward, I think just think more about the fact that we're changing regimes from a Fed tightening cycle to a Fed easing cycle, which also is changing regimes from a rapidly growing economy to probably a less rapidly growing economy. So that's going to create some volatility as the market digests all this data that comes out. We don't want to overreact to short-term data points. We want to think kind of where things are going from a broader economic cycle perspective, which I guess these data points give us an idea of where we are, but in reality, we'd like to zoom out and see, where we are relative to last year, last 3 years, last 5 years, last 10 years, to get a better idea of where we might be in the cycle, and that allows us to allocate capital more effectively for the point in time.
Yeah, and there's another regime change I think we're going through, which is going from a market where all that mattered were 7 companies and AI to a market where they actually realize that there is another 490 three companies in the S&P 500 that are also relevant.
Last night was the first Harris-Trump debate. Adam, what are your thoughts after watching that?
Oh man, what entertainment! I think if you're a debate purist, you're very unhappy. Like, but if you're a debate purist, and I don't mean like you didn't get laid in high school, and you watch that, and you're just thinking, wow, no one answers any questions, no one says anything with any detail. It's a reality TV show more than a debate. The only stock that I knew would be affected today was Trump's Truth, whatever it's called, his social media platform, which somehow became public. Which, come on, SEC, what are you doing? I would just look. You watch it for the entertainment. I think it was meaningless in terms of any portfolio changes or adjustments. I think it was absolutely meaningless.
Austin, any thoughts on the debate last night?
It's really just campaigning, and sometimes the market overreacts to some of these campaign agenda items that candidates come out with. I think at the end of the day, for any of these big picture plans, you're going to need votes from the Senate and Congress to get it done. So let's wait and see what actually happens in the election before getting too excited or upset on who gets elected as president. I think from my perspective, the debate just solidified the fact that they're both going to be relatively ineffective at the position of being president of the U.S., and they're likely not going to get much done. So unless something changes there, I think it's probably something that people should kind of ignore.
Yeah, and I mean, coming out of the debate, I didn't know if I should go long or short pet food, but I know there's a trade there.
And Adam, I agree with you. It really wasn't a debate. It's just a sideshow. It's a mockery of what a debate should be. Next topic: the banking sector's come under some pressure here recently. Adam, what are your thoughts?
Well, it's interesting because earlier in our discussion, Austin mentioned we were talking about the macro data. Austin mentioned that all these data points are backward looking, and the banking sector came under particular pressure yesterday. I think even J.P. Morgan was down 5%, which I think was its biggest percentage drop in a long time. And why? Because they spoke about forward numbers, forward guidance, stuff that's happening in the future, not the past. And the market can be very slow to sort of accept those changes. We've all been talking about these rate cuts for months. We know it's probably a 25 or 50 basis point cut, but for some reason, people hadn't extrapolated to the impact of that on net interest income for investment banks or for banks, excuse me. And at a conference, when you've got all these CEOs chatting and making comments publicly, and they say, "Hey guys, your numbers are way too high. Rates are going to come down, and we're not going to print those kind of numbers." And then you saw that reflected broadly across anyone with big commercial banking exposure.
Austin, what are your thoughts?
It was a unique day because we had two issues that came out on the same day that were supposed to work in opposite directions for bank stocks. You had the Fed reducing the potential capital requirements under the new regulatory capital regime for the big banks, which should have been a very good thing for banks. But then on the other hand, you had, as Adam referenced, all the CEOs coming out at a conference basically saying, analysts, your numbers are way off. We're not going to perform as well in the future. And what we've seen in the market this year is people are much more focused on future estimates than they're focused on what's happening today. So obviously, those comments from the CEOs and CFOs were detrimental to share prices. I think as you see a stabilization, the news out of the Fed is going to be a good thing for larger banks because if they have to hold less capital, that means they have the potential to lend more and even in a lower rate environment, get more leverage on the capital that they have and potentially increase those interest margins to something that's more in line to what the analysts expected. It's a unique time. Let's see how things kind of shake out. I think it's also unique that the Fed's coming out at this stage in the political cycle and essentially saying, okay, banks, you can lend more than what we had initially indicated you could, effectively pumping more money into the economy without necessarily making a significant, I would say, policy change. It's only a policy change for the banks. And since the banks have been withholding so much, trying to get to these higher capital requirements to date, it allows them to kind of release those constraints a little bit, which should be a source of liquidity for not just businesses, but also for markets going forward.
It was a tough day yesterday for Elizabeth Warren.
Our next topic is around the yen carry trade, which is thought to have driven a lot of the volatility we saw in the markets here last month. Is the yen carry trade still unwinding? Adam, what are your thoughts?
It's hard to tell, to be honest. I know I don't want to speculate. I think any of the trade like that can be done in such magnitude that that there's a chance that it's still unwinding, or after the August hiccup, people put the trade back on, and so it's sort of, it will unwind again. It's not even necessarily, maybe it's semantics, but it's not necessarily part of the same unwind that we saw happen with so quickly in early August. But if after that blip in August, if some of what drove the market back to new highs was people putting that trade back on, then guess what? It could be deja vu all over again at some point in the next few months.
Yeah, I think at the height of that, Goldman had put a note out saying they thought about 75% of it was already unwound after the volatility had hit. So if they're putting it back on, Austin, what are the implications?
Yeah, if people put it back on when rates actually come down, when the Fed actually reduces interest rates, that will reduce the spread between interest rates on the yen and interest rates on the dollar, which will likely cause capital to flow out of the U.S. because what's happening is the carry trade has people borrowing in yen and then investing money into the U.S. That could create more of a hiccup for markets. It seems like it's a bit far to speculate saying that that's going to be the next issue for markets. A lot of people like to kind of continuously fight the last battle instead of focusing on new issues that could pop up. It seems very unlikely that you're going to catch the market off guard with something that was perceived to cause so much of an issue in early August. But it could happen. People might just be, assuming that the Fed's not going to reduce rates, or assuming that they can get out faster than others, and it could create, the issue of, it's kind of like the fire in the movie theater where the first few people get out, but then the bulk of people end up in a not great situation.
Or if people are banking on the 20, kind of locked in this 25 basis point cut, and it ends up being more than that.
All right, and our last topic for today. I'm very fortunate. I get to work with hundreds of advisors across the country. And for the past decade, I have the same battle with each financial advisor I work with when we start talking about their portfolio process. And that's putting international exposure in their portfolios. It's hard given what performance has been in the international markets. Austin, why is international diversification so important today?
International diversification is important because it gives you exposure to different fundamental drivers. Mainly different economies are growing at different speeds globally. What we've seen over the last decade, though, is the U.S. has been the dominant growth engine globally. And so people have paid up for U.S. companies because they're outgrowing the rest of the world. That's not necessarily going to last forever. A lot of that was driven by the same trade that's causing the 493 companies in the U.S. to underperform the top 7 companies in the U.S. There are a handful of global beneficiaries that happen to reside and be listed in the U.S. As those global winners or winner-take-alls stop taking all, we expect there to be a broadening of beneficiaries from economic growth. We also think that there are some international economies that are positioned to grow relatively well. And so investors will benefit from having exposure to those economies because you can actually get them at far better prices than the U.S. One thing we would caution against is just blindly buying international markets, assuming that cheap prices will give you beneficial diversification. What you really want to look for is attractive prices that also have solid underlying growth. That's the type of diversification you should be striving for.
Adam, what are your thoughts?
Well, I agree with everything Austin said, and I guess I'll just add this, which is sometimes people make the argument that, well, I own the S&P 500, and a lot of the big companies, the S&P 500, generate a lot of their revenues in international markets. Look at, Apple and how important the Chinese market is to Apple, how important China is to Starbucks, and so on and so forth. But that's a different kind of international exposure than actually owning some basket of companies that are domiciled and have the majority of their revenue in overseas markets. And it's another vector of diversification, which just allows you to grow your wealth with lower volatility over time, which is the goal. The goal is to be very comfortable in retirement and all the hard work you're doing with whatever, whether you're pumping gas or giving lap dances. You want that money to grow over time. And it's another way to diversify and make sure that money's there for when you retire.
Gentlemen, thanks for your time. To learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.